Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to discuss a difficult reality that Canada and many other rich countries have to deal with over the coming years. It has to do with the huge debt burdens these countries have and how, in a world of rising interest rates, these growing debt burdens will force governments into uncomfortable positions and some tough decisions with respect to their budgets. First, I want to highlight that Canada is not alone. This standardized data from the Bank of International Settlements is of gross government debt as a percentage of GDP. As you can see from the chart, Canada's debt-to-GDP ratio is in the middle of the road and comparable to the G20. However, I'll point out that above 90%, according to economists Ken Rogoff and Carmen Reinhardt, these debt levels can have significant drag on economic growth. The next chart is of Canada's government debt over time, and there's a couple of things worth noting before we proceed. One, as keen observers will point out, is the Stats Canada number in this chart is much higher than the BIS data, and that's because the BIS uses a harmonized definition of debt to make cross-country comparisons possible, whereas the national sources include different types of liabilities and tend to be a more reliable figure. The second takeaway is that the gross debt figure includes provincial debt. While the federal government is not officially the lender of last resort, its fiscal dominance and historical precedent suggest it will act as the de facto backstop in any crisis. And so we include it in the overall number. For the sake of simplicity, we'll focus on federal government debt. The data is cleaner and everyone from coast to coast is on the hook for it. And as we'll see in nominal terms, it now sits at an all-time high, the debt having doubled over the last 10 years. It's important to note that this is gross government debt, the total debt owed with no accounting tricks. I bring this up because net debt, a figure that's often paraded around, is a lie, and it's used as a cover for being fiscally reckless. What is net debt, you ask, and why is it baloney? To calculate net debt, governments take gross government debt and subtract pension plan assets. That means your savings to theoretically pay down federal government debt. Not only is this a morally bankrupt view of our finances, it's unclear if this is even legal. When you hear net debt, it should raise alarm bells. So now that we understand a bit better how much debt Canada has on the books, why is it top of mind and why will it become a problem? Sigh, because of the election and the ballooning deficit spending as parties promise the world with little regard on how they will pay for it. Remember, it was just a couple of months ago that Canada's previous finance minister quit or was fired after blowing the doors off the budget deficit. It was delivered late, and it was a disaster, being 50% higher than it was projected. But how quickly we forget. So much for keeping any fiscal dry powder. Fast forward to the election, and the convenient boogeyman of tariffs and the trade war means that the government can dispense with maintaining any fiscal discipline whatsoever. Carney platform figures in pink made the previous Liberal government look positively austere by comparison. The Liberal Party has clearly abandoned any pretense of fiscal anchor. Far less crazy, but still negative, are the projected deficit figures from the Conservative platform in black. What's clear is that both leading parties are set to run deficits. But let's not forget that these are just forecasts. Everyone has a plan until they get punched in the face. As regular viewers will know, we have argued that Canada is slipping into recession. In our view, growth will get worse before it gets better, and that means revenues will fall as more and more people lose their jobs. This is important because Canadian federal and provincial governments are already running deficits, so we should expect all these figures to grow regardless of who wins. So who cares? Well, there's no free lunch. Despite the desperate attempts of some politicians to convince us otherwise, deficit spending matters. Any kind of deficit spending means adding to your debt burden, and that debt has to be paid back eventually, and in the meantime, it must be serviced. We call this interest payments, and of course, they're related to bond yields. The problem that Canada faces is that debt levels are high, and much of the debt issued over the past few years is coming due. This means that debt charges, or interest payments, will continue to rise because this debt will be refinanced at much higher bond yields. This is why the slogan, "Spend less, invest more," is so insidious. It is designed precisely to bamboozle the layman. Deficits are deficits. Debt is debt and interest payments are repaid via higher taxes or inflation. The problem is that the federal tax take is already at a 22-year high. A growing economy can also increase tax revenues without raising tax rates, making it easier to service interest payments and reduce debt levels. But over the past few years, nearly all of Canada's economic growth has come from population increases via immigration, as productivity growth has been negative. This is not at all sustainable. More people will not solve the problem. Canada needs to increase its productivity growth. Another problem is that the tax base is shrinking. The number of working-age people is falling as a share of the total, i.e., there will be fewer people able to service the debt. So why not invite even more people from abroad? Well, besides putting pressure on wages, housing, rent, healthcare, schooling, and infrastructure, which would hurt the young and working class and favor the old and the asset holders, never mind the growing social frictions, it also fails to address the underlying issue, and that is productivity growth. And with it, the lack of private capital investment. This promise that we are going to invest more, in theory, is good. Capital investment from the government is important. Some projects cannot and should not be undertaken by the private sector. But that is not enough. The number is too small. And ultimately, it's not the problem. Canada is desperate for private capex. No capex, no productivity, and productivity growth is what counts. The sad truth is that profligacy, being reckless with your spending, has a price, and that price is getting expensive. Right now, debt charges are higher than the federal healthcare transfers. These debt charges will rise because interest rates are higher than when much of the debt was issued. Government slogans to spend less and invest more, besides being completely meaningless from an accounting perspective, are doubly dangerous if they do not seek to directly attack Canada's productivity emergency and encourage private investment. Okay, that's a wrap on this week's episode. Thank you very much for listening. Please like, subscribe, and follow for more. And as always, we manage for money for families all across Canada and the world, so please feel free to get in touch.